Hello everyone, my name is Wade Cook. I'm glad we can spend this time together on this video presentation of some great stock market strategies. What I'd like to show you here today is some great ways of making money, building up your cash flow, and really get that cash hitting your account so that you've got extra money to spend and to retire on. The whole theme here is to get rich and get rich as quickly as you possibly can. What we're going to talk about is this, what I call barbecue. We're going to have a big barbecue today. Barbecue, BBQ, stands for bigger, better, and quicker. Bigger returns, better meaning more often, more frequently, and then quicker, meaning hitting your account, actual cash. Now, you know, one of the things we're going to have to talk about here before we get into this, we have to explore some possibilities and how much money you can possibly make. So when I use the word yield or rate of return, you got to understand what that means. See, let's say that you have an investment where you make $1,200, but it costs you $10,000 to make that kind of money. The way to figure rate of return, then, is to divide the cash in, the money that you're taking in, the gain, the profits, if you will, by the money that you spent or invested in the investment. Now, I come from real estate days. You know, I was a cab driver, and then I started getting involved in real estate. Let me show you a typical real estate deal. In a typical real estate deal, you have a house that's worth $150,000. You buy it and turn it into a rental house. Let's say you take in $1,500 a month, but your payments going out are, say, $1,375. So you make $125 a month. Well, you take that times 12, generates a nice return, a nice income, say $1,500. Well, if you put down $15,000 as a down payment to buy the property, and you have $1,500 income back in, then your rate of return obviously would be 10%. 1,500 divided by 15,000 equals 0.1 or 10%. That'd be a 10% rate of return. And you would think that we kind of learn our lesson here in this country, but I don't think we do. See, everything in this country is done as annual returns, right? You go into a savings and loan, you are waiting in line, and you see this great sign there that says CDs, 5.65%. But then it says underneath that 6.02% effective yield. Now, what does all this mean? You see, again, I'm going to come back to this real estate because it's very important, but if you put $10,000 into a CD and you get a 5.65% return, it's not totally true because, in fact, the money is compounding. Either daily, weekly, or monthly, the bank is compounding, and you're earning interest on interest. So if it says 6.02, what it really means is that you're going to make $602 on your $10,000 CD at the end of the year. This is what we call a rate of return. Now, what I'd like to spend time with here today as we go through this is a cash-on-cash return. Let's go back to the real estate. You see, along with this real estate deal, getting the rental income of $1,500, you also have depreciation expense, right? Because you're going to depreciate take out the land, depreciate the property, divide by 27.5 years, and you get so much per year. That's a tax savings, and that could be calculated on your yield. Oh, and the property is growing in value, so you could also calculate that if you wanted to. Well, I want to ignore all of that. I want to ignore the tax savings yields. I want to ignore the growth in the property and just talk about a cash-on-cash rate of return or yield on your money. Now, the next thing I've got to deal with is this. We in this country are so wrapped up into the word annual. May I encourage you to get rid of that word? Just eliminate it from your vocabulary. There's no more annual anything. Annual is boring. Annual doesn't cause you to think right. We need to start thinking monthly returns, 2-week returns, 1-week returns. And if you do that, then we'll start you along the road to thinking like a cash flow millionaire. And that's the point. So before we get on to some of these strategies, I want to talk about you. Why are you watching this? Why did you spend your money to buy this home study course? What do you need? Are you into cash flow? Do you want to have more income? Now, there are 3 reasons for investing in any kind of investment, real estate, stock market, or whatever. One of the reasons for investing is for cash flow. The second reason for investing is for the tax write-offs. And the third reason for investing is for the growth, the wealth, the equity, something down the road. Now, why real estate? I mean, it's been a popular form of investment because with real estate, you can get all 3 of these at the same time, and you don't need a lot of money to get started. Now, with stock market investing, you really can't get all 3 of these, and you can go for the cash flow, you could go for the growth, and by the way, very few stocks produce tax write-offs. There's a few that I'm going to talk about a little bit later. But you get the cash flow or the growth sometimes together. This is the point. Cash flow, tax write-offs, or growth. What do you want? What are you after? My contention is that most of you want more cash flow. So that's what this is all about, building up monthly income. Now, for you to understand what I'm all about, and where I've come from and those kinds of things that make it possible for you to make a lot of money, I want you to come with me back a few years, and I'll just tell you my brief history. I was a cab driver in Tacoma, Washington. People think I'm joking about that, but I was card number 22 yellow cab. I was selling life insurance a couple nights a week. I was teaching early morning church class. I was driving a school bus and a ski bus on some weekends. I was doing all the stuff trying to pay the bills. Anybody been there? Matter of fact, I'll bet most of you watching right now are too busy to get rich. You're so busy doing mundane stuff that you don't have any time to make any kind of serious money whatsoever. And there I was doing all this stuff just trying to pay the bills. Then I went to one of these rah-rah, you can get rich in America seminars, right? Go out and buy a house, go out and buy a duplex, and all your problems are over. They don't tell you that when you buy that house or the duplex, all your problems are just beginning. But I bought into it. I really got excited about this real estate. I was going to become a real estate investor. Now, I didn't have any money. I had to borrow $500 from my father to buy my first little house, little junky house. Second house, the guy wanted $1,000 down. I didn't have $1,000. I said, look, I'm driving a cab. How about if I pay you $250 every Monday for a month? He goes, okay. And I checked the taxi out on Friday night. I slept in it Friday night. I slept in it Saturday night. When I finally made the $250 on Sunday morning, I checked the cab back in and take the guy's money on Monday for the next 4 weeks. Now, that's how I bought my houses. If any of you have a sob story, I'd love to hear it because I got a million of them. I should have never done what I've done. But what I did is this. I got tired of it. I had all these rental properties. You know, how you do your financial statement, you take your assets and your liabilities. I was worth $120,000, and I didn't have the money to pay a $65 electric bill. So what I did is I put one of my little houses up for sale. Everybody started telling me, no, don't do that. Just hang on, hold on. You know, the old buy real estate, the eternal real estate plan, buy real estate and wait. Well, I bought into that concept, and I had all these equities. I was worth $120,000 in equity, but I didn't have the money to pay the bill. I decided if I was going to get really, really wealthy, I was going to have to do something totally wild, totally different, totally crazy. Now, I got to take time out on that word crazy. Can you all deal with that word for a second? I'm talking about being crazy. I mean, I got to tell you about my daughter. I eat Chinese food almost every day, just to remind myself to be a little bit crazy all day long. I called home. My daughter gets on the phone. She goes, hi, Dad, I love you. You're crazy. She calls me crazy 3 or 4 times a day just because she knows that I like it. By the way, let me tell you about this kid. We're visiting Grandma in San Diego. And she goes, Grandma, you're sure getting fat. Grandma, what are those wrinkles on your face? And my wife finally says, Carrie, you don't talk to women about their age and you don't talk to women about their weight. Later on that night, Carrie came out of Grandma's bedroom. She says, Grandma, I've been back in your bedroom and I saw your driver's license on the dresser. Now I know how much you weigh. I know how old you are, and I know that you got an F in sex. All right? Now, if you're going to stick out, stick out. Just be crazy as you can. Let me tell you what I did. I put one of my houses up for sale. I didn't think it was that crazy. You know, you got bills to pay. You got something worth something. Sell it, get the cash, pay the bills. But everybody was calling me names, saying, you ought to not do that. Well, let me tell you, this has happened to me too many times to deny that I walk into a bookstore and the book falls off the shelf and it opens up in my lap and I read a page and it's exactly what I needed at that point in time in my life. I mean, I run into people and I get to talking with them and whatever they're telling me is exactly what I needed. It's happened from health points of view. It's happened from emotional and spiritual points of view. Well, let me tell you what I read at this time in my life. There was an article in Forbes magazine, and here was a quote by Malcolm Forbes. Now, this is the dad, the guy that started the magazine. He said, no success is ever accomplished by a reasonable man. That's too important to pass it up. Let me say it again. No success is ever accomplished by a reasonable woman. All right, now come with me on this. Stick out. Do something aggressive. Do something big time. So let me tell you what I did. I put one of my houses up for sale, scared to death. I ended up selling it. About 2 days before the deal's closing, the bank calls me and says, Mr. Cook, we're sorry, we got a problem. Oh, no, Chuck's okay. The guy that you're selling the house to, he's okay. He's getting more, he's okay. But the house has that old kind of foundation, and we just don't make loans on old houses. I didn't know what to do. I was discouraged. I was depressed. I ended up selling the house to Chuck on a contract, what you would call owner financing, where I took his down payment and I carried back a mortgage on the property. Now, Chuck is making me payments. Now, I got back $2,200 from him after all the closing costs. Now, this was on a little junky house. I put down $1,200. Now I'm getting back $2,200. I make $1,000 profit, and Chuck's payment coming into me is $60 a month higher than my payments going out. I'm going to make, net, keep, go to the grocery store and spend $60 a month for the next 28 years. Now sit here and dream with me. Stare at this $2,200 check in my taxi and tell me what you would go do. That's right, I sold some more properties, and I got, and that became the basis of a whole investment concept, which put the emphasis on selling, not on buying. I wrote a book called How to Build a Real Estate Money Machine. It's been in, I think, its 9th or 10th printing right now. It's now called The Real Estate Money Machine, and it's been very successful. Well, let me tell you what this led to. Once I had a hardbound book in the bookstores, what happened is that I started doing radio and TV talk shows. I got invited to do a lot of radio and TV talk shows, and I've done about 1,600 of them now, and it's been a real thrill. This cab driver from Tacoma is now out doing all these radio shows and doing seminars all around the country, now even internationally. Well, I was very successful at the seminar business. My books were selling well in the bookstores. I mean, things just kept going really well. And I had all this extra money. Well, I started buying some second mortgages with that extra money, but then what I did is I started putting some money in the stock market. Well, everything I seemed to buy went down in value. I mean, I bought one mutual fund that had gone up 14% a year for 3 years in a row. As soon as I bought it, minus 2%. I bought some stocks that went up and kind of floundered around, but most of them just went on down. I buy them at $9, they go down to $6. I was so discouraged by, just so angry at the stock market because you had to learn a whole new set of new language, new jargon. You had to learn all new strategies. You see, I could apply some of my real estate strategies to the stock market, but not all of them. Well, I was very frustrated with it, and I got a call one day from a stockbroker who said, "Wait, I'd like to take you out to lunch." And I said, "Sure." So we went out to lunch that day, and he said, "Let me tell you what I've got a bunch of my clients doing." He said, and by the way, I did this at first with Motorola. If I know the stock ticker symbol, I will tell you what it is, but Motorola. He said, "I want you to buy some stock at $50 a share," which I did. And now I bought 100 shares, which is $5,000, plus about $80 in commissions. He said, "Now, I want you to put in an order to sell this stock at $60 a share." I said, "Okay." So I put in the order. Now, if you've been investing in the stock market, you could take off and go to Hawaii, and if the stock hits $60 a share, the computer is going to trigger a sale, and you'll have the money. Well, sure enough, 6-7 weeks later, this stock got up to $60. The computer triggered a sale, and I sold it. I had $6,000 minus about $90 in profit. So I had, for this 6-7 week period of time, made $830. Now, this is not growth. This is not growth. This is actual cash in the account. I mean, cash in the account, $830 plus the original $5,000. Now, he said, put in an order to buy the stock again at $50 a share. I said, "How do you know it's going to get down to $50 a share again?" He said, "Wait, just do it." I said, "All right." So I bought 108 shares at $50 a share. He said, "Now put in the order to sell it at $60 again." I did that, and it was sure enough, 6-7 weeks later, it got up to $60. And it sold at 60. By the way, one time I sold it at 60 and it went up to 61 and 62. See, I lost out on some of the profits. And another time, by the way, when it got down to 50, it even went down to 48 and $49 a share, and I was getting kind of worried, but then went right back up to 60. Now, I got to tell you something. I sat and did this with Motorola for about 3.5 years. And I got to tell you, I thought I had hit the mother lode. I mean, talk about a cash flow machine. Just sit there and every 3, 4, 5, 6, 7 weeks. Now, I call this rolling stock. Hey, if you look up the word rolling stock in the stock market dictionary, it'll say livestock transported on the railway systems of America. That's their idea of rolling stock, not mine. My idea of rolling stock, some people call this channeling. Let me use 2 different pens here. Some people call this channeling. You see the channel there? It goes between a resistance level at the bottom and a resistance level at the top. Well, I don't call it that. I call it rolling stock because it rolls between a certain range. And I thought that Motorola was the only company out of the 25,500 publicly traded companies in America, this is the only company that did this roll between certain ranges. Now, I'm going to continue on because I'm going to show you some of these strategies for making a lot of money in the stock market. And I've even got some charts here to show you. I like going to movies. I love going to movies. I mean, people don't understand how much I like going to movies. I go to 1 or 2 movies a day. I mean, I usually work at the office for 2 or 3 hours. I hit the 1 o'clock movie. If my office wants me to sign some checks, they have to come down to Kent 6 Cinemas and find me, and I'll sign some checks for them. I love going to movies. Several years ago, I found this little theater. Well, it's not a little theater. It's a big theater chain called Cineplex Odeon. It's a Canadian company trading in the United States. The ticker symbol is CPX. I love the theater chain. It had those little runway lights down, and that was really a cool little theater that I was in. I said, I wonder if this stock is publicly traded. Sure enough, it's a New York Stock Exchange company, and it was at $3 a share. So I bought it at $3 a share, and as soon as I bought it at $3, bam, it went right down to $2.50. So here I go again, buying a stock that's going to lose me money. Then I just started watching it because I had several thousand shares, and it went from 2.5, and then it got up to 3.5, and then it went back down to 2.5, and then it went up to 3.5. And I said, man, the next time this sucker gets down to 2.5, I'm going to buy a bunch of it. Well, that's what happened. The next time it dipped down to 2.5, I bought a whole bunch of it, and then it would go back up to 3.5. Now, I'm going to show you this in a little bit more detail because I want you to see how this is played out. And everything I talk about on this video and everything we talk about in our seminars is always done in 1,000 share increments. No big reason for that except for it's easy to multiply. At $2.50, that'd be $2,500. $2.50 per share times 1,000 would be $2,500. So you have $2,500, and depending on what kind of brokerage account you have, then you'd have, you'd have anywhere from $30 to $110 in commissions on that. All right, now, this stock goes up to $3.50, and if the computer triggers a sale, and as soon as you buy it, you can put in your order to sell it, then you sell it at $3.50, and you'd make $1,000. Now you'd have, let's say, $100 in commission, so you'd have $900 in profits for 3 or 4 or 5 weeks. So $2,500 generates $900, and by the way, sometimes in a really short period of time. Been a couple that I've done that I bought them at 2.5, and they've hit 3.5 in the afternoon. Buy them in the morning, sell them in the afternoon. Some of them I've doubled my money on. All right, then it goes back down to 2.5, you buy it again, and then you sell it again at 3.5. And you just keep doing this repetitiously over and over and over again, and you turn this into a cash flow machine. Now, I want to show you some charts, some other ones. This is going to be a little bit harder to see these with the white, but this is the chart. This is by Telechart 2000, by the way. And this is a stock here that's called AGBAG International. AgBag International, the ticker symbol is AGBG. This stock goes from right around $1.25, which is this level right here, up to about $1.75, and sometimes even up to $2. So you buy it at $1.25, sell it at around $2. Buy it at $1.25, sell it at $2. Buy it at $1.25, and we're just waiting for this one to go back up right now. This is a typical rolling stock. Let me show you another one. Here's one that is, this chart's kind of weird because it took a big dip here as it recently. But this one here, you buy it right around $3, you sell it at $4. Buy it at $3, sell it at $4. Buy it at $3, sell it at $4. And I've had several of these from RYO, Royal Oak Mines, Amex Gold has been a good one, Cineplex Odeon. One of my favorite ones, because my wife really liked it, was TCBY. The ticker symbol is TBY, you know, the yogurt company. That one rolled between 5.5 and 6.5, 5.5 and 6.5. For years, it's been rolling between 5 and 6.5, sometimes $7, but right in that range. Now you see, once you get this charting down, and by the way, I got to tell you, I made hundreds of thousands of dollars before I ever saw my first chart. I really like it now because you can even go back 5 years and see a company history, or you can just get like the last year and see where it's gone, you know, where it's been and all that. So here's another one. This one you buy it at $8, down in this range right here, and you sell it right around $9.25 right here. Again, this is another one. Look at how fast this one rolls. It's like every 3 or 4 weeks, this one rolls from $8 to $9. Now, I don't know if those kind of profits are appealing to you, but think about what I just said. Think about taking $2,500 and turning it into $3,500 in a few weeks. Let me give you another example. There are a couple rules, and I think we need to cover those before we go on. Okay, rule number 1 is that you always know your exit before you ever go in the entrance. You see, we're not doing this type of investing, buying a stock at $2, waiting for it to go up to $10, right? We're buying this stock at $2, waiting for it to go to $3. And then we sell it 3, and we wait for it to go back down to 2, and we buy it again, and we wait for it to go back up to 3, and we sell it again. You get to know these companies. They get to be your pals, your buddies, because you get to know them. You get to learn when their quarterly reports come out. You own stock in them, so you get all the information about the companies. All right? Know your exit before you ever go in the entrance, and rule number 2 is you don't get greedy. Just don't get greedy. All right? This is the key to this whole thing, by the way. I don't want to wax too philosophical on you here, but maybe we should. Maybe we should even bring up a scripture right now. I firmly believe, everyone, that you and I can live our lives out of most of the principles taught in the Bible, especially from a financial point of view. In the Old Testament, there are just nothing but rule after rule after rule for dealing with these kinds of things. There's an old Hebrew law, and you can find this in Leviticus 19:10 and Deuteronomy 25, that says, "Thou shalt not glean the field." Now, what does this mean? Glean the field. You could go through the first time and pick the wheat, the corn, the grapes, whatever, but you could not go through the second time and get what you missed the first time. You had to leave some there for the widows, the fatherless, and the poor. It was God's way of taking care of other people. You see, the same thing in making money. In real estate, for example, I would buy a house that may be worth $140, pick it up for $100,000 on a foreclosure, but sell it to someone for $120,000. Make it a good deal for the next guy. Leave some profits there for the next guy. Back to these stocks. If you get greedy, for example, I'll talk about Cineplex Odeon. It would go from 2.5 to 3.5 to 2.5 to 3.5, 2.5 to 3.5 every several weeks, and once in a while it'd pop up to 4. Once in a while. 2.5 to 3.5, 2.5 to 3.5, and maybe way down here. So like every, about every 6 to 9 months, it'd pop up to $4. If you were waiting for it to get to its peak, every now and then when it get way up to its peak, you would have missed all these rolls. You see, from 2.5 to 3.5, in the last 5 or 6 years, it's rolled over 30 times. Now, think about this. $2,500 buying 1,000 shares of this stock, you could have made somewhere around $30,000 over the last 4 or 5 years just rolling this one. Now, let me tell you about America West Airlines. I like bankrupt companies. I don't like them right when they're going into bankruptcy, and sometimes I don't like them when they're coming out. But bankrupt companies, there's a couple reasons for liking them. Number 1 is that bankrupt companies are not going to go into bankruptcy. They've already gone from $30 down to $1, right? Now, they could go lower. They could go to 50 cents or a quarter, but they really had their biggest hit. And once they get down there, once they bottom out, then they start going from $1 up to 2, back down to 1, up to 2, back down to 1. Why? Because the second reason why I like bankrupt companies is because they're news driven. You see, the price of the stock has nothing to do with the value of the company. America West Airlines is going to get a bunch of new jets. Boom, the stock goes up. The deal doesn't go through, the stock goes down. The judge is going to give them a 6-month filing extension. Boom, the stock goes up. He only gives them 2 months, the stock goes down. Ansett Airlines from Australia is going to put in $30 million. Boom, the stock goes up. They only put in $10 million. Boom, the stock goes down. You see the point? It's news driven. There's nothing to do with the value, the intrinsic value to the company. It's all about news. All right, so let me tell you what happened. A few months ago, we were doing our tax returns. My wife says, Wade, do you realize how much money you made in my IRA? So she had put $2,000 into an IRA. We opened it up at Charles Schwab, put $2,000 into the IRA, and 4 months later, in 4 months, the account was at $19,600. Now, I don't know how much money you make in your IRAs, but that's a nice 4-week rate of return. I mean, there's almost no way of measuring that. She goes, you made $19,600. Now, I made a little over $200,000, about $220,000 on America West Airline and all of my different accounts. But in just her IRA that she was handling at that point in time, and I said, well, Laura, I didn't really make $19,600 because you have to take the $2,000 I started with. I only made a $17,600 profit. You see the point, though? I mean, think of this kind of rate of return. I don't know what kind of money you're making, but I got to get you to quit thinking about 4% a year and 6% a year. You need to start thinking about doubling your money every 2.5 to 3 months, and that's what we're going to move on and show you right now. Rolling stock was my first way of making money, my first great way of making money in the stock market, simply by treating the stock market like a business. Buy low, sell high. Get good at something. Repetition is the key to success. And instead a hamburger in Tampa Bay tastes like a hamburger in San Francisco Bay. Think about it. McDonald's does not make all of its money every year selling one big gigantic hamburger. They make it by selling billions of little ones. So the same thing here. Get to be a millionaire repetitiously, doing something over and over again until you get good at it. You get to be an expert at it. All right. I want you to look at these numbers here. I read a book several years ago that said this. If this guy took a bunch of millionaires and he did an interview with them, and he sent out questionnaires, and literally thousands of people responded, and he actually interviewed hundreds and hundreds of people. And what he found out was this. These people got to be millionaires by getting to be experts in their field. Now, yes, some of them made it through real estate, and some made it through oil and the stock market, but most of them made it by getting to be an expert. For example, one guy was an engineer making $30,000 a year. He kept going back to college. He kept taking other advanced classes, and pretty soon he was making $60,000, $80,000, $90,000, $110,000 a year. He was still living on around $40,000, and he was able to sock aside like $50,000 a year into an account. These guys were not rich. They were not investors. They were rich by investing a little bit of their money in themselves, and they were only getting like 5 to 6% returns on their money. Not a lot, not a lot. Now think about this. If you could take and get a high rate of return, get to be an expert either in real estate or get to be an expert in the stock market, pick rolling stock or covered calls, which we're going to cover in just a minute, or options, then you get to be an expert in a field that has a high rate of return. There's just no substitute for knowledge. And knowledge is power. I know that sounds cliche, but it really is true. And that's why we do our Wall Street workshops around the country, which I'll tell you about at the end of this course. I want you to see what we do at a Wall Street workshop and tell you about it so that you can make a decision if you want to come and spend a couple days with my staff and go through and actually do the deals, do hands-on and get hands-on experience making money in a classroom. Now, the next two strategies I want to show you are really minor strategies. I'm going to show you two major strategies in just a minute. These two minor strategies involve taxes, and they also involve another cash flow strategy. One is called dividend capturing. Now, I'm not going to spend a lot of time on this. There is a lot more information on these in the home study courses, the audio home study courses, and the manuals that go with this. Dividend capturing. Just be very brief. When a company pays a dividend, they usually do so on a quarterly basis. For example, Kmart a couple years ago made an announcement that it was going to do a dividend of 28 cents. Now, that was a quarterly dividend. The stock at that time was around $15.50. It said that it was going to pay the dividend for all owners of record of the stock as of August 6th, and it would actually pay the dividend on August 31st. Now, you can find a page like this in Barron's, in Investors Business Daily, in the Wall Street Journal a couple times a week, and you can find out all the companies that are paying a dividend. Now, I particularly like companies that are paying like an 8% or a 10% annualized dividend. Here's the point, though. Do you realize that you could go in and own this stock on August 6th, which means you'd have to buy it 3 days in advance to have it actually in your account? But if that stock is in your account on August 6th, you captured that dividend. Now, if you purchased 1,000 shares, there'd be 1,000 times that, or $280 that you would have in your account on August 31st. You could sell the stock on August 7th, so you captured the dividend. You could sell the stock on August 7th, it'd be out of your account 3 days later, and it doesn't really matter, but you capture the dividend. Now, if you do this in a corporation account, then you qualify for the 80% dividend exclusion rule or the 70% dividend exclusion rule, whereby you only have to claim 70 or 80% of the dividend as income, but in that case, you'd have to hold on to the stock for 45 days to qualify. This dividend capturing works best in a pension plan, an IRA, or something like that. You can literally capture 150, 200 dividends a year if you're really diligent. Now, yes, you have commissions to worry about. And by the way, on that $15.50 Kmart stock, I sold it a couple days later for $16.50. So I had a dollar capital gain on selling the stock, but I also captured the 28-cent dividend. It's a great way to get busy, and that's what it takes, by the way, is a lot of busyness to get good at dividend capturing, because it takes so much time. I don't actively do that one. I'm going to show you the ones that I actively do here in just a minute. But before I do that, I do want to show you a tax strategy. Probably all of us are paying too much in taxes, and I really don't like paying taxes at all, and I'll pay my fair share. But I try to do everything legal that I can within the guidelines of the Internal Revenue Code to make sure that I'm paying a minimal amount of taxes that I possibly can. Let me show you one possibility. The IRS allows you to receive tax credits. Now, a tax credit is a dollar-for-dollar write-off on the taxes that you actually owe. Let me give you an example. Let's say that you're making $140,000 a year. Your taxes on that would be $36,000. All right? Now, if you get a $10,000 tax deduction, that $10,000 deduction would go right against $140,000, and you would then now make $130,000. And you'd save about $3,000 in taxes if you're in about a 30% tax bracket. See, the 30% of the $10,000. But if you had a $10,000 tax credit, you know, on your 1040, you go through the front part of your 1040, and you list all the different kinds of income that you have. You turn over the page, and you got up at the top of the page, on the back page of the 1040, is you figure out your taxes. You go through the tax bracket that you're in, and you figure out the tax that you actually owe. Well, the next box right below that on your 1040 is the tax credit. So after you figure out how much in taxes that you owe, the tax credits go right against that as a dollar-for-dollar write-off. So in this example, if you have a $10,000 tax credit, it comes right off of the $36,000. You now owe $26,000 instead of $36,000. So in effect, depending on your tax bracket, a tax credit is about 3 times better than a tax write-off. All right, so I like tax credits. So let me show you one that any one of you can invest in. There are a lot of tax credits available in real estate. You have low-income housing credits, Section 42. You have historical credits. But there's one that a lot of us can invest in the stock market. It is called Section 29 energy credits. All right, let's talk about the Section 29 energy. I'm going to give you an example. I invest in a company called Williams Coal Seam Royalty Trust. This is a New York Stock Exchange company. The ticker symbol is WTU. I purchased several years ago. I'm going to show you what I did in 1994. I purchased 200 shares of the stock for right around $21 a share. All right, and I owned it for 2 quarters for that year. Actually, I owned it for 3. I bought it the second quarter. I owned it for 3 quarters for the year. This company produced for me about $130 in income for the 3 quarters, which was about $380, $390 total. Well, after they take out all the expenses, which you can deduct, which was about $60 or so, it came out to where I had to claim as income $330. All right, so would you if you had this stock. You own the stock, and the stock could go up or down, but that's not the point here. The point is that it produces income, which is not a bad rate of return. See, $21 times 200 would be a little over $4,000, and for $4,000 to generate $390 in income, that's not a bad rate of return. Now, though, the taxes on this. If you're in about a 30% tax bracket, you would owe about $110, about $100 or so in taxes. Let's say $100 in taxes. But if you go on down further on the 1041 that they give you, a 1041 is the miscellaneous income statement. When you get your 1041, it shows you that not only do you have the income, not only do you have some depletion allowance, but you also have tax credits of $305. So the tax credits will wipe out all the taxes on this income, and you still have $205 in tax credits that you can use to wipe out taxes on other income. This is a phenomenal, phenomenal thing to invest in. Now, your equivalent rate of return, again, depending on your tax bracket, is somewhere between 9% and about 23%. depending on what price you paid for the stock and your rate of and your tax bracket. Not a bad return. Again, that's an annualized return. I told you to get rid of the word annual, but still not a bad return considering that you can now get these tax credits on companies that hopefully are growing in value at the same time while you're using the tax credits to wipe out the tax that you owe on the other income that you're going to make. Those two minor strategies are just there. I teach 11 different strategies at the Wall Street Workshop, and I want to move on now and show you my other two favorites. Rolling stock used to be my favorite, but not anymore. Now it's my third favorite way of making money, though it's my first. And it's still one of my favorites. It's not my favorite because I found two other ways of making money faster. Once again, what we're talking about is cash flow, actual cash hitting your account. I'm not talking about growth. I'm not talking about buying mutual funds. I'm talking about money hitting your account or having your stockbroker send a check to your house. But it's actual income that you make. Remember cash flow, tax write-offs, and growth. We're going for the cash flow. So in order to show you these next two strategies, they both have to do with options. One strategy is on buying options. The second strategy is on selling options. In order to show you both of these, though, I need to give you a quick vocabulary lesson. So let me take you through some definitions here. And again, I keep repeating this, but there's a lot more information in the audio cassettes that I put on the stock market cash flow systems. There's a lot. I mean, if you want to make zillions of dollars, then we got to get you up to speed here. And I'm trying to give you that here so you can visually see what we're talking about as compared to listening to them on an audio and reading the manuals. Okay, let's talk about options. There are four kinds of options. There's options on interest rates. There's options on indexes like the Standard & Poor's index. And there's options on foreign currencies. I'm not going to talk about any of those. What we're going to talk about is options on stocks, a stock option. Similar to buying real estate, but not quite the same. Let me give you a real estate example once again. You find a house that's worth, say, $140,000. This house, all fixed up, could be worth $180,000. And the guy's willing to sell it on contract. He's willing to let you in with a small down payment, but he wants $50,000 down. You don't have the money. Now, you could make a fortune fixing up this property, but you don't have the money. So you say to him, look, I don't have the $50,000. How about this? How about if I put down $3,000, $4,000, $5,000? And I'll take an option to buy the house, and I will pay you the balance of the money, or all of the money, the $140,000, in, say, 6 months. All right, now let's think about this 6 months. You've got 6 months to do something. And if you don't do something during that 6 months, you are going to lose your $5,000, right? You've taken the house off the market. He's agreed to sell you the house at the $140,000 within 6 months, but you got to do something. If you don't do something, then you're going to lose your $5,000. So an option is a fixed time investment. Now, if you own the house, whether it goes up or down in value, you still own the house. But when you buy an option to buy the house or pay for an option to buy the house, it's a fixed time investment, and you could lose all or part of your money. So options are very, very risky, not only in housing, but in the stock market. So I encourage you to get the booklet called Characteristics and Risks of Standardized Options. It's put out by the Chicago Board of Options Exchange. Any of your stockbrokers will give it to you for free. It's a little booklet called Characteristics and Risks of Standardized Options. All right, let's go to this play right now. Let's say you go along about 6 months and you just have not been able to fix up this house. You just didn't get the loan. You don't have the money to do it. So you go to your builder friend and you say, builder friend, and by the way, if you could make it, that'd be one play. Boy, it'd be great. Get the money, fix up the house, sell it, make $30,000, $40,000 in profit. But what if you couldn't? So after 3 years, a guy at church is a builder. You say, hey, I got this option to buy this property. I can't do it. How about if you do it? So he pays you, say, $5,000 or $10,000 or $10,000 or $7,500 for your option. So you could actually make money by selling your piece of paper, which is the option to buy the property. All right, now, this is very, very common in real estate. And most people have never seen it happen in the stock market. So let's now talk about buying an option to buy stock. It's not a down payment on the stock. It's not a down payment at all. An option is simply this. I'm going to go through these definitions right now. An option is the right, not the obligation. It's the right to buy or sell a particular security, a stock, at a set price, called the strike price, on or before a certain date. Now, let's talk about that certain date. Expiration dates for options are always the third Friday of the month. Technically, it's 11:59 a.m. Eastern Time on the Saturday after the third Friday of the month. But functionally, it's the third Friday because the options market and the stock market is closed at 4 p.m. Eastern Time, 1 p.m. my time, and Pacific Time on Friday, the third Friday of the month. So that is the expiration date. So let me go through the definition again. An option is the right, in parentheses if you want, not the obligation, to purchase a security on or before a certain date at a specific price. Now, options are always in 100 share increments. So if I say an option costs 75 cents, automatically in your brain, that should mean $75. because you have to buy them in one contract. So this equals one contract for $75 plus a commission that you're going to pay your stockbroker for selling it to you. All right. Options start at $5. And then they go in $2.50 increments. So they go $5, $7.50, $10, $12.50, and on up to $25. At $25, then they start going in $5 increments, which are $25, $30, $35, $40, and on up to $200. At $200, they start going in $10 increments, $200, $210, $220, and so on. Now, most of the options that I buy are in these ranges down in here. I hardly ever buy options on stock that are over $200, or options on them at that high price. And by the way, when we get to covered calls, you're going to see that most of our options are in this range right here. All right, so I'm just trying to cover these sorts of things so that you understand some of these plays. The next thing we need to discuss is in the money, out of the money, and at the money. Now, we're going to explain all this in terms of an example. Let's say that you really like Ford. Ticker symbol is F. Ford is currently around $26 a share. You really like this company. Got great earnings. It's got news coming out, and you think that this stock is a $32 to $35 stock. You think it's going to go way up there. So you call your stockbroker and you say, how much are options out there? Now, a $25 option could cost you $2 or $3. But let's say you're going for a $30 strike price and a $30 call. Now, I'm going to put this back up in just a second, but I want to show you something else first. In the options market, there are two plays. There's one play where you buy an option to buy stock. That is called a call. A call equals the right to buy. A put equals the right to sell. Now, I don't want to confuse you here, but you can buy a call and you can sell a call, and you can buy a put and you can sell a put. For example, on any given stock, on any given option, it could be like 75 cents bid, $1 ask, right? And a put could be $1.25 bid and $1.50 ask. See, there's somebody buying and selling calls and puts all the time. Now, when you buy a call, you are hoping that the stock goes up. When you buy a put, you are hoping that the stock goes down. Now, we don't have time to explain all these. Again, there's more in the home study courses on this, but now we can get back to Ford. And so you can see how this all comes together. Now, the key to option buying comes down to this one sentence, and listen carefully to this. When there is a small movement in the stock, there is a magnified movement in the option. Okay, now, we're going to explain that, but I'm going to say it again. When there's a small movement in the stock, either up or down, there's a magnified movement in the option, up or down. So if you think Ford's going to go to 26, you're buying a call. Now remember, when you buy a call, you're hoping that the stock goes up. All right. Let's say that the call is 75 cents, and you're buying it out there a month or two. You really think Ford's going to go up. That would be $75. Now $75, let's say you buy 10 contracts, that would be $7,500. Oops, I'm sorry, $750. $750 is what you have out of your pocket to buy 10 contracts. Now, I was thinking $7,500 because I was thinking about buying 1,000 shares. If you bought 1,000 shares of Ford, that would cost $26,000. Now, if you did it on margin, let's talk about margin for a sec. Margin accounts mean that whatever money you put into the account, you can buy twice as much stock. Now, this is an important one, so I want to share this one with you. If you put $10,000 into your brokerage account, most of your stockbrokers will allow you then to buy $20,000 worth of stock. How does this work? How does it work? I mean, you now own $20,000. You can buy up to the $20,000 worth of stock. You have what is called buying power of this amount of stock. How does this work? Well, the way it works is your stockbroker is going to loan you the other $10,000. So $10,000 of your cash is buying stock, and then your stockbroker will usually match that, or double that if you will, and let you buy $20,000 worth of stock. He gets an interest on this. He's actually loaning you the money, right? So the stockbroker makes money that way and also gets a larger commission. You see, the stockbrokers love these kinds of things because they like making extra money. And by the way, I said 50%. You could even get margin accounts to where you can trade at 30%. That's about where I am. If I want to buy $10,000 worth of stock in some of my accounts, I have to bring in $3,400 because I'm at 34% margin capability. All right. Margin accounts allow you to trade big time. Couple points: don't ever use up all your margin, because if the stock takes a dip down, you may have to bring in more cash or more securities to cover the collateral. See, the $10,000 is acting as collateral. If the stock goes down a little bit, you may have to bring in more money. Hence, and also if the stock goes up, you may call your stockbroker and he'll say, oh, you've got more buying power, so you could buy more stock because the stocks have gone up in value. This is what is called a margin account. And I really recommend when you open up your account, you not only get it to trade on margin, but you tell your stockbroker you want to buy options. They may not let you do all the option plays, like selling puts and some of those kinds of things, but the simple option plays, like writing covered calls and buying simple options, they should allow you to do, even in accounts that only put in $2,000. Now, every brokerage firm is different. They all have their different rules, but still. All right, let's go back to Ford. Let's go back to Ford. Let's show you this play now. Here's the stock, and here's the option. The stock was at $26. The option is at 75 cents. The stock now goes to $28. The option, say, goes to $1.50. The stock goes to $30. The option goes to, say, $2.25. The stock goes to $32. The option goes to, say, $4. Then the stock goes to $33. The option goes to $5. Now, again, I'm just putting like the last price or whatever here because there is a bid and an ask on any one of these. Now, here's the point. I want you to look carefully as I go through this. The stock went from $26 to $30, or to $28. That is less than an 8% movement in the stock, but look what happened to your option. Your option doubled in value. What you purchased last week or a couple weeks ago for $7,500 or $750, you could now sell for $1,500. Now, yes, you'd make a little bit more if you bought the stock for $26,000 and had it go to $28,000, but look at the cash that you have to tie up. Option investing is what I call proxy investing or surrogate investing. Instead of buying the stock, you're buying an option on the stock, and you see again, when there's a small movement in the stock, there's a magnified movement in the option. Look once again. The stock went from $28 to $30. Just another slight rise in the value of the stock, but look what happened. Now you've tripled your money from 75 cents to $2.25. What you paid $750 for, you could now sell for $2,250 and have a $1,500 profit. Pretty good, huh? Pretty neat returns. Now let's talk about in the money, out of the money, and at the money. These are very important to understand. See, if the strike price is $30 on our play right here, you can see that a $26 stock is out of the money by $4. The $28 stock is out of the money by $2. The $30 stock is at the money. So when a stock is at the money, it simply means that the price of the stock and the strike price of the option are the same. When a call option is out of the money, it is out of the money when the stock value or price is lower than the option price. Now, in the money, here's an in the money option. If the stock is at $32, somebody out there may be buying and selling options on it, which are the right to buy or sell the stock at $30, but it's in the money by $2. See, a $32 stock is in the money by $2. $33 is in the money by $3. All right. Now, I'm trying to show you all this to give you a quick lesson on these plays, because now we're going to show you how I make a lot of money with these. I'm going to show you my second favorite way now of making money, and once again, I've got to give you a quick little vocabulary lesson, just very briefly to understand some of these terms. We're going to talk about writing a covered call. Writing a covered call. When I use the word write, write is synonymous with the word sell. Right? So write a covered call. Now, y'all understand what a call is. A call equals the right to buy stock. Now, if sell means to write, so writing a covered call, let me try to put this in a sentence that you can understand. It is to sell an option for someone else to buy stock from you that you already own. All right, let me say that again. You're writing a covered call. Covered means that you own the stock. You actually own the stock that you're selling. The question is simple. Do some of you at home have stock right now that you would be willing to sell? Maybe stock that you bought at $9. You were hoping it was going to go to 20. It's gone to 10. It's gone to 11. Back down to 8. Back up to 9. Back to 10. And it's just floundered around. You bought it at 9. Would you be happy to sell it at $10 or even at $12.50, that next strike price up? Well, if you are, then call your stockbroker and just say, how much, is this stock optionable? Are there options written on this stock? Yes, there are. Then how much can I get for writing a call? Let me tell you what I do. I've been buying Novell Computer. I really liked Novell several years ago. I still like it as a company, but boy, this stock, it had done wonderful things with all the stock splits for many, many years. I started buying the stock around 30, and I started buying a whole bunch around $20, $22. But boy, every time it dipped down to, the ticker symbol is NOVL, Novell Computer. When it dipped down to $16, $17, $18 a share, I was purchasing a whole bunch of this stock. I ended up owning 3,800 shares. Now, I was hoping that the stock was going to grow and become worth $30, $40 a share, but it never happened. It would get up around 19, 20 once in a while. I got so tired of it. That's a lot of money. This back when I had a couple $100,000 in my account. Well, 3,800 times 16, 17, $18 is a lot of money. So I told my stockbroker, man, the next time Novell gets to $20 a share, sell everything that I have. He goes, well, Wade, if you want to sell it at $20 a share, why don't you write a covered call on it? I said, what's that? Now, this is the second time I've heard about writing covered calls. I heard that Warren Buffett, you know, one of the major investors in America, is really good at writing covered calls. What is writing a covered call? And over the next couple of hours, and now after the last couple of years of my studying and applying and getting into the techniques and fine-tuning the strategy, we've turned this into a literal cash flow machine. But I'm getting ahead of myself. Let's get back to this. I said, well, how much can I get for that? He said, well, right now the bid and the ask for writing a call for the next month, this was like October a couple years ago, for the November calls, it is $1 by $1.25. This is the bid and the ask. Well, when you sell, if you're going to sell at the market, you sell into the bid. I could sell this for $1 per share, or 38 contracts if you want to do it that way, but $1 a share. I said, hold it. You're telling me that I can sell an option for someone to buy, to give someone the right to buy my stock at $20 a share, and somebody's willing to pay me $3,800 cash right now? I mean, you get this count, by the way, it clears into your account in one day. Somebody's willing to give me $3,800 cash now to give them the right to buy this stock from me at 20, and I'm perfectly happy to sell it at 20 anyway? He goes, that's right. And I said, well, this is a no-brainer. Do it. And I sold it. The next day I had $3,800 cash in my account, and I have now sold away the right for someone to buy this stock from me at $20 a share. Well, let me tell you what happened. That next month, I got called. The stock was right around $20.25, just slightly above the strike price, and I didn't get called out of all of them. Can't explain it. You know, sometimes you do, sometimes you don't. Think about this. Somebody has purchased the right to buy it at 20. If the stock's at $20.25, you'd think I'd get called out of all 3,800 shares. I didn't. I got called out of 1,100 shares. And I still had 2,700 shares in my account. And I said, now hold it. Then how much can I write the December calls for? And I think they were $1.25. And I sold 2,700 times $1.25. And the next month I got called out of 900 shares. And then I had 1,800 shares left. And I said, now hold it. What can I sell those for? Now by this time the stock had run up to like $21, $22. And I sold the $20 calls for $2. And I got another $3,600, 1,800 times 2. And I got called out, and then went back down around $20.50, and I got called out. And the next month I sold the balance of the 900 shares, I think at about $1.75. Look at all the cash I generated. The original $3,800, an additional $3,000 here, an additional $4,000 here, an additional almost another $2,000 there. See, I was selling the call, writing a covered call. Again, covered means that I actually own the stock. Now, you could write uncovered calls. We're not going to talk about that right now. What is called going naked. I do that all the time. As a matter of fact, right before I did this taping, I was doing a bunch of covered calls on the way here, and uncovered calls, which means that I was selling the call on stock that I didn't own. A little bit riskier. Some of you can't do that. So if you come to the Wall Street Workshop, we'll show you that strategy. I'm not going to have time here to do it during this tape. But anyway, writing a covered call. Let me give you an example. And now I'm going to show you the Wade Cook covered call formula. The Wade Cook covered call formula is a great way of applying these formulas to make this money repetitiously. Once again, cash hitting your account every month. See, there's three things that make this work. Three rules, if you will. One of these rules is that you need to do this on margin. If you're going to understand how much money you can make, and then I'm going to show you some really neat things that you can do with this money later, but you've got to do it on margin, which again, you put in $5,000, you can do $10,000 worth of stock. A second thing is you need some volatility. You need the stocks going up and down a little bit. For example, between the $8 range and the $12 range, something like that. So there's quite a roll to the stock. And also, you need to do stocks in the 5 to say 20, sometimes up to the $25 range, but somewhere in this range right here. And this is a good point. I need to prove this one out to you a little bit later on. All right, so with this in mind, now let me show you the Wade Cook formula. And I'm going to do this by using an actual example. A company that we did a few months ago, Perceptive Biosystems, ticker symbol is PBIO. We bought this stock right at $9 a share. Now again, I'm going to show you the formula. $9 times 1,000 shares would be $9,000. Now we'd always divide by 2 because we're doing this on margin. So there'd be $4,500 cash that you would need in your account. $4,500 cash, which would again, that's on margin, so we're going to do this on margin. Now we go shopping. The next stage is we go shopping. We call our stockbrokers and we say, what are the options? All right, so now, Let me go back to some of these rules. We want that volatility. You know, to make a lot of money, we need to buy low, sell high. Now let me turn that into a business sense. We need to buy wholesale, sell retail. Now let me turn that into a stock market, and specifically the covered call formula. We need to buy the stock on weakness, or wholesale if you will, and then sell the call on strength. Remember, when there's a small movement in the stock, there's a magnified movement in the option. So if we want more money out of the option, sometimes we have to wait. We have to wait a little bit. Now remember, everything we're talking about here is a 2-week, 3-week, a 4-week return. We go shopping, and let's say that it's October. We call our stockbrokers and we say, what are the November calls going for? And he says, well, right now the $10 strike price calls are going for $1 by $1.25. Now that could be 75 cents or $1. It could be $1.25 by $1.50, depending on the price of the stock. As the price of the stock, $9, gets closer to and then above the strike price of $10, it could even be worth a lot more. And we'll explain that one in just a minute. So let's do it at $1. We sell the call. We sell. Remember, we're writing a covered call. We sell the call for $1. $1 times 1,000 shares would be $1,000. So now we have $1,000 cash hit our account the very next day. Well, what have we done here? Now we bought a stock at $9, and now we've sold to someone who we don't know this person. See, we don't know this person. There's somebody that's gone into a stockbroker's office in Tallahassee, Florida, and he really likes this Perceptive Biosystems. He said, I like this stock, and he's in there buying a call at $1.25. We don't know who this person is. We don't know at all. But we've sold the right to someone out there, Never Never Land, the right to buy this stock, to take it away from us, to call us out of the stock at $10 a share. Now, if the stock stays around $8, $9, $9.50, we're not going to get called out, but we get to keep the $1,000 cash. If the stock goes up to, say up to $10.50, maybe $11 a share. All right. On the third Friday of the month, on the expiration date, we find out that we got called out. Actually, we don't find that out until the Monday afterwards. And you don't need to do anything to do this. You don't need to do anything extra. It all happens electronically. Basically, your account has been assigned, that stock in your account, and it comes out of your account on Monday following the third Friday. Now, the cash will actually hit your account 3 days later on Thursday because you sold the stock, and stock clearances are 3 days, T plus 3, trading day plus 3, options clear in 1 day. You now have $1,000. Well, what's your rate of return? Well, let's go to the formula. In order to figure the rate of return, we take our cash in, which is $1,000, and we divide that by our cash out, which in this case was $4,500. Now, I don't have my calculator here, but you have to stick with me on this. So this is our rate of return, which in this case is about 22%. 22% rate of return for 4 weeks. Now, again, this is 4 weeks because we bought the stock in October, and we sold the November call for $1. Now, I don't know what this would be times 12, but we're looking at around 300% return on our money here. All right, now let's move on. The stock moved up. We got called out. So we sold the stock at 10 on the stock that we bought at $9 a share. So we now have $1 profit times 1,000 shares. We have $1,000 in capital gains. Remember, this 1,000 is the 1,000 that we have from selling the premium, selling the option. Now we have $2,000. So basically we have a 44% return on our money, over 500% on an annualized basis. Now, if you are not getting 22 to 40% a month returns on your money, you need to either get good at this formula on your own, working with your stockbroker, reading some of my other books and the home study courses on this, or come to our Wall Street workshop, which, again, I'll tell you about later. Let me give you another one. One that we just did. We bought a stock at $4.50. It's $4.50. This is a few months ago. This was on a company called Scorecard. They make baseball cards. During the strike a couple years ago, the ticker symbol, by the way, is BSBL. The stock had gone down from like $10 or $12 down to $4.50. We wrote the $5 call. We sold the $5 call. Now let's do the numbers. $4.50 times 1,000 would be $4,500. All right, we divide that by 2 for margin, and we get $2,250. So that's our cash invested. Now, the stock went up. The stock went up. Remember, we buy the stock on weakness, and then we wait a little bit, and we sell the call on strength. Now, think about this. If you're writing a covered call, you have to hold on to the stock until the expiration date, so you don't need to be in a hurry to sell the option. You can just wait. So you wait a couple weeks, maybe a week or so, and the stock goes up to around $5.50. Now, remember, we're selling the $5 call, and if the stock's at $5.50 or $5.75, well, here's what we did. We got $1.50 for selling this call. $1.50, which $1.50 times 1,000 shares would be $1,500. So we spent $2,250 A week or two later, we get $1,500 hitting our account. Now, the stock was at $5.75 on the expiration date, and we got called out. So what additional did we make? Well, we sold the stock at $5 that we had purchased at $4.50. So we have another 50 cents times the 1,000 shares, which is another $5,000. Or I'm sorry, $500. $500 times $1,500, or plus $1,500 is $2,000 on a $2,250 investment. What is our rate of return? I mean, sometimes I don't even want to write these things down because they get so phenomenal. We're talking like 80, 90% return, an annualized return of close to 1,000% on an annualized basis. And again, if you're not making this kind of money, you need to come along with me and figure out the covered call formula. I think you've already figured it out. And if you haven't, you can just review this tape and rewind it back to where I said covered to take the stock times the amount of shares that you're buying, divided by 2. That's your cash invested. Now you shop around. All right, let me give you another example. I'll do it again. I'll do it again on one other example. A company that we just did, right before we did this taping, was a company called Interneuron. Interneuron something. They have pharmaceutical drugs and all that. The ticker symbol is IPIC. Now, we had purchased this stock at 14 5/8. 14 5/8, which is, well, it's $14. It's $14 and 62.5 cents. Again, times 1,000 would be $14,625. Now, again, you divide that by 2, which is $7,812.50. Now, then we sold. We waited for the stock to get up around $16, and we sold the $15 call. Again, what are we doing here? We're agreeing to sell out at $15. Now, one time we sold out at 15, and then we bought the stock again when it dipped back down, and then the next time the stock ran up to 16 or 17, and then we sold the $17.50 strike price. In this example here, we're selling the $15 strike price for about $1.50. So now, once again, you have $1.50 times 1,000 generates $1,500. And if you get called out, you bought the stock at $14.62. You're selling it at 15, so you pick up another $375 for getting called out. Again, that's $1,875 on a $7,800 investment. Another 15, 18, 20, 22% return. Now, I have done, in the last year and a half or so, about 97 different stocks. And I'm looking for more all the time. 97 different stocks. During that time, we have had 3 of them have gone substantially down. For example, we bought one stock at 11, and we wrote the call at $12.50, received a nice premium, and we didn't get called out, by the way. We wrote the call the next month on a $10 premium, and we didn't get called out, and then the stock dropped clear down to $6. Now, remember, we have this premium here, which I think was like $1,500, and another premium here, which was like $1,000. I don't remember the exact numbers, but you'll catch the point. We sold the calls, and we have the cash. Then the stock dropped clear down to $6, and we had to wait for it to come back up to 9. Of the 3 companies that have gone down, all of them have come back up, and we've been able to make money on these stocks once again. But the other 94 stocks have kind of floundered around in that range. Now, let's talk about that range, that $5 to $20 range, and I'll show you how important it is. If you buy stock at $4.50 and you're writing the $5 call, you're going to get about 75 cents to $1.25 for writing it. If you buy stock at $19 and you're writing the $20 call, you're going to get about 75 cents to $1.25 for writing it. If you buy stock at $48, $49 and you're writing the $50 call, you're going to get about 75 cents to $1.25. If you buy stock at $98, $99 and you're writing the $100 call, you're going to get about 75 cents to $1.25. See the point? On the next strike price higher for the next month out. Now, if you're willing to go out several months, you could get a higher call premium, but then you have to hold on to the stock for 3 months instead of 1 month. I like 1 month maximum rates of returns. Take the cash now. Now, I can't go through all the different power strategies with this. I mean, there's all kinds of things we could teach you about cleaning house and all that, and these are in other parts of the home study course. I just want you to get the basics here and why you need to be in that $5 to $20 range, right in this range right here. Because you can buy a lot more stock at $9 a share than you can at $99 a share. And if you're going to get the same premium, why not earn a premium on a $9 stock selling a $10 call than on a $99 stock, right, selling a $100 call? You see the point? So you can buy a lot more stock with a lot less money. All right. Now, this is writing covered calls. And I want to do an exercise with you. Matter of fact, I want to show you how important this can get. And I've got some... I've got a chart here. I want you to look at this. I'm going to go through these numbers with you. These are important numbers, everyone. And let me tell you what I've got up here on the screen. We're going to start with, say, $1,300. The reason I picked that is because I had a friend who had $1,300. We're going to take the money times 1. 1 being that we're going to leave the money in the account. Yeah, okay, so we're going to leave it in the account. The question is this. If you have $1,000 or $5,000 or $10,000, could you put it in the brokerage account and let the money just sit there for a year? If the answer is yes, if you don't need to pull it out to live on, if you can just leave it there, then could you not then compound profits on top of profits? Leave the cash there. Leave the premiums, leave the capital gains there. All right, so let me show you what I'm not calculating for this example here, what I'm not doing. I am not figuring in margin interest. It is so minimal that I'm just going to ignore it for this example. Number 2, I am not figuring in commissions. Again, they're expensive sometimes, but they're so minimal compared to the profits that you make. And the point is, don't go tripping over pennies on your way to dollars. Commissions are really minimal. But number 3, and this is the most important one. Number 3, I am not going to figure in capital gains. Now, in real life, we get called out of these stocks every month or two. We get called out of these stocks, which means that we buy the stock at 9, we sell it at 10. We buy it at 6, we sell it at 7.50. We make $1.50, $2 on these capital gains all the time. But I'm not going to figure in those capital gains. I'm going to ignore them for this example because these numbers will get so huge. I mean, it's going to be hard for some of you to believe these numbers anyway. Now, all of you that don't have very much money, okay, listen carefully because this will give you some hope. And by the way, I got to tell you, this is exactly where I am and what I'm doing. You start with $1,300 and you take that times 1.2, 2 being the 20%. Now, in real life, 1 month you're going to get 22%, the next month 28%, the next month 17%. That's real life, and we understand that. And again, if you get called out that it's 42%, like some of the examples I just showed you. But I'm just going to stick with the 20%. So 1,300 times 1.2 is $1,560. Remember, you don't have to pull any money out. So you leave the money in the account, you take 1,560 times 1.2, and you have 1,872. Now, this is January, February, March. Look what happens to the numbers. Look how big they start getting. You leave the money compounding in the account. Boy, it really starts to get interesting here in July and August, because now you've got some nice money working for you. Then up to September, October, November, and look what you have. At the end of December, you have $11,590. Now, take away the $1,300 that you started with, you still have a profit for the year of around $10,000. Now, when I say double your money every 2.5 to 3 months, and a lot of the advertisements for these things, I'm showing you how it works. You repetitiously do this. You get good at it. You find the stocks, you sell the calls. You find stocks, you sell the calls. And by the way, if you're not on our WIN, our computer bulletin board service, you definitely need to be on WIN. You can call 1-800-872-7411 and get on WIN. WIN stands for our Wealth Information Network. Now, I don't give any advice, but every day I put on there everything that I do. Now, if I have a day that I take a vacation and don't do anything, I don't put anything on there. The day before we did this taping, I made 6 entries on the WIN on different stock plays, option plays that I was doing during the day. So you can log on 24 hours a day, 7 days a week, and find out what I'm doing. So if you want to learn the calls that I'm writing, if you want to learn the stocks that I'm playing or the options that I'm playing, you can just log on to WIN. You obviously need a computer. It's a computer bulletin board service. And by the way, if you sign up for a year, your year does not start until you actually log on. So again, call for more information on WIN. Again, it stands for Wealth Information Network. Let's go back to this. You now have started with $1,300. You have in your account $11,590, profits of over $10,000. And by the way, in real life, if we added in our real commissions, our real rates of returns, it's really almost unbelievable. All right? But also, we did not figure in the capital gains. Now, think about that. If you get called out, make a buck here times 1,000, that's another $1,000, another $1,000. This is substantially more than this. Now, I'll probably get a little bit too personal with you here, but I want to show you what this means. If you have more than $1,300 to get started, if you can start with, say, $10,000, what this means is at the end of the year, your $10,000 repetitiously, growing again at 20% a month, will make about $100,000 at the end of the year. So your $10,000 becomes $100,000. Now, if you really have a lot of money to get started, if you have $100,000 in your account, and by the way, there are multi-billionaires that are doing this writing covered calls, and they're very, very good at it. But if you start with $100,000 at the end of the year, you'll have about $1 million. Now let's get back to the beginning here. This all started with $1,300. Now, if you can leapfrog and get right to the 10,000 or get right to the 100,000, you really have a head start on this. But even if you start with $1,300, and by the way, I've got students all over the country that are doing this. Even if you start with $1,300 in 1 to 10,000, 2 to 3 years, in 3 years, you could have. Get a little bit lucky, get diligent at this, and get to be an expert at this, you could have $1 million. Now, ladies, I want to talk to you for a second because women make such better investors than men. Let's say that you're tired of this. You're tired of working 15, 20, 30 minutes a day at this, and you're really busy 2 times a month, right after the expiration date and about a week before the next expiration date when you've got to sell everything and clean house and work it. but you're tired of this. So you go to your husband and you say, honey, I know you're not as smart as me, but I want you to take over the account. I want you to start managing the account. I know that you're not going to get 20% a month, dear husband, but you could possibly get 10% if you'll just work and make half the amount of money that I've made. Well, even if your husband runs the account for you, this will still generate $100,000 a month in income. Again, I'm saying a month, per month. Now, I don't know if that gets you excited or not. And by the way, I'm way above that right now. I started doing this about a year and a half ago. I had about $100,000 in one account, $200,000 in another account, and I've rounded them up over $1 million. I've been able to take that money now and buy some hotels and some major hotel chains. I've been able to buy about a $3 million house, all from money that I made. Now, I have a company that's making money. We take the money from the company, put it into brokerage accounts. We take the brokerage account money and have that making money, and then we're able to take that money and put it into other investments or to keep that money working for us. At the time of this taping, I was about $140,000, $180,000 a month of money that I made doing exactly what I'm showing you here. I don't teach anything that I don't do, and I don't do anything that I don't teach. So it all comes together. All right, it all comes together. And boy, talk about coming together. Now let the excitement begin. This is going to get really exciting because now we're coming up on the #1 way that I make money in the stock market. Again, it has to do with options, stock options, but this time we're going to do a different play. See, we talked about proxy investing. Remember we talked about that? Proxy investing, surrogate investing. Instead of buying the stock and spending a lot of money, we spend a lot smaller amount of money, but we control a large block of stock. The problem is that it's a fixed time investment. See, options are risky because if the option expires, you lose your money. And only about 15 to 20% of all options ever get exercised, which means that about 80% of all the people that invest in options lose their money. They lose their money. I mean, they're gambling that a stock is going to either go up or down, and they lose their money. Well, we don't want to lose money. And I really dislike losing money. So the 3 plays. 1, if you're going to make money in options, is you play the news. You play news, all right? And you just get good at that. Number 2, you play extraordinary events, all right? And that's a big one, like a merger, an acquisition, a turnaround, or something like that. And number 3, which also could be considered news, is a stock split. And that's the one that I want to spend time on right now. A stock split. For example, about a year and a half ago, 2 years ago, McDonald's, McDonald's hamburgers, the stock had climbed up to $60 a share. They made an announcement that they were going to do a 2-for-1 split about a month later, and the stock, by the way, was really at 58. It climbed up to 60, and then it split down to 2 shares at $30 a share. Now, they do this, the board of directors meets, so that the average Joe out there can buy stock in this company. The stock continues to go back up. Now, I want you to spend a minute on this. You find me a company, I'm making you a challenge right now. You find me a company that has done a stock split where a year or 2 or 3 later, the stock is back down or was even at its original price. See, the stock has a tendency to regain lost ground, to climb back up to that $60 range. I don't know if the board of directors knew this, but it happens all the time. It happens so frequently. I mean, I'll give you a compact computer a few years ago, but other than that, you would have a hard time finding a company that has done a stock split where the stock has stayed down and where it's split down to. It just doesn't happen. Very, very seldom. And for every one company that you could show me, I'll show you 25 or 30 companies that have regained lost ground, that have gone from $80 down to 40, or 120 on a 3-for-1 split down to 40, and have gone right back up within a year or 2 back up to the higher range. Let me give you an example. In April actually of 1994, Microsoft announced that it was going to do a stock split. Now the stock at that time was like at $78, $80 a share, and the stock climbed upon the 2-for-1 announcement. They was going to do the stock split on May 23rd. On the 2-for-1 announcement, the stock started climbing right up to 90, 94, 98, and it backed off to $94 a share right before the split. And then it split into 2 shares at $47 a piece. 2 shares. Now, then the stock climbed right back up. These $47 within a year were right back up around the $100 range. At the time of this taping, they were just under $100. Think about that. Think about that. Doubling your money in a year. And by the way, this is when Bill Gates passed up Warren Buffett as the richest man in America. He was worth $6 billion. And then it did the 2-for-1 split. Now, bam, all of a sudden he's worth $12 billion. And by the way, if it continues to grow, it may do another split. And then it'll be worth $24 billion, and so on and so on. All right. What does this have to do with options? What is this stock split all about? Well, if one of our worries is losing money, and if we really want to have a strategy that helps us minimize our risk, then why not invest in stocks or options on stocks that are going through a stock split? See, if there's a tendency for the stock, even if it flounders around a little bit right around the stock split time, if there's a tendency for the stock to regain lost ground, why not buy an option on the stock, say out at least 1 month, but out 5 or 6 or 7 months, and buy an option and wait for the stock to grow? Let me give you an example. Intel, ticker symbol INTC. Intel stock was right around $88, $90 a share. They made an announcement that on June 19th that they were going to do a 2-for-1 stock split. The stock immediately started to climb up to the 114, 118, and it even got up to $121. But then it backed off to about $114, and then it split into 2 shares at $57. At 57 bucks. Now, I want to show you what happened. When it first made the announcement, I played some May of 1995. I played some May 1995 $95 calls. That's not what I want to show you here. I bought some LEAPs. LEAP stands for Long-Term Equity Anticipation Securities. These are options that are written out like 1 and 2 years in advance, like the next January of the next couple of years. I bought the January $100 call options for $13.50. And I purchased the January $120 call options for $4.50. Now here's what I'm doing. I am purchasing the right to buy Intel at $120 clear out in January, about 7 months away. I've locked down the right to do that. And I bought 10 contracts, so that'd be $4,500 here and $13,500 here. And I purchased the right to buy this stock. Again, when you buy a call, you're hoping that the stock goes up in value. Now let's show you what happened. When the stock splits, the option also split. So now, the options that I purchased for January at 100 now turn into the January $50 calls. The January 120s turn into the January 160s. So now I have the right to buy Intel at 50 and at $60. Oh, by the way, when the stock splits, the option split, which means now I have 20 contracts of each of these. So instead of having 10 at 100, I now have 20 at 50. Ooh, does this get exciting? And by the way, when the option split, the stock splits, and also your cost basis splits. So my cost on purchasing this option is $6.75. My cost on this one is $2.25, half of this and half of this. Now I have $2.25 invested in each one of these $20. You know, that by the way is a $225 to buy these options, each one of these 20 contracts. Now let me tell you what happened. The stock immediately ran up from 57 up to 60, 65, 70, and $72. I mean, I think it even bumped against $75 for a while. Now, I had purchased these about the second week of June and the first week of July, 3 weeks later. So a 3-week play. The stock got up to around $72, $75. These options got up to $18, and they bumped off at $21. I sold about half of the contracts at $18 and half of my contracts at $21. And on this one here, I sold part of my contracts at $8 and part of my contracts at $9. And let's get specific here. If this costs $200, you know, if my cost on 10 contracts is $2,250, when I sold them, I make $8,000, or at $9 a share, I make $9 per option, I make $9,000. Now think about this. $2,250 got me $8,000, and then I sold the other $2,250 for the other 10 contracts at $9,000. Not a bad 3-week return. I just got to tell you, I love options on stock split companies. We have not eliminated the risk, but we sure have minimized the risk because we're investing in companies that are going to do a stock split. Now, I'm going to just show you a couple more things about this, and then I'll give you a couple more examples. One, in the stock split arena, in this type of stock split, and the options here, there is a short-term play and a long-term play. The short-term play, well, let's do the short-term play first because it's up here, but I mostly do long-term plays. If the stock is right around $80 and it's going to split, say, in December of that year, and you, at that point in time, you buy, say, the January $80 calls or the January 85s. You buy an option, and they're usually not very much money, say $3 to $6 for the option. You buy the option really close to the price of the stock. You choose a strike price close to the price of the stock. 80 or 85 or even $75. And you're going to hope that the stock is going to move to $82, $84, $85, $86 before the expiration date in January. And then you could double or triple your money very easily on that. The long-term play is that instead of buying the $80 calls, you go to the 85s or even the $90 calls, but you go clear out in, say, April or May of next year. Now, the cost on these is going to be like $2, maybe $4. So you're paying a relatively smaller amount of money because only if you're buying the $90 calls. But you're buying time. you're paying a little bit extra money. For example, the April $80 calls, we're probably going, where here they may be $6. Here they're going to be like $12. Why? Because you're paying for that extra time, called the time value to the premium. And that's a lot of money to pay. So what I do is I go another strike price higher, and then I buy them because they're so much cheaper. Why? The gamble is that the stock may not get up to $90, but we know something about this stock, that it's done a stock split. So if the stock even goes up to $85 before the stock split and then splits down to 2 shares at $42.50, again, we have the right to buy it at $45 because our $90 price becomes a $90 call becomes a $45 call. All right, so let me give you a couple more examples. A couple of days before we did this taping, there's a company, I don't know where it is, but it's called Automatic Data Processing. The ticker symbol is AUD. Now, this stock is just bouncing all around because they announced a 2-for-1 stock split. We purchased these calls for $2.75. We bought 10 contracts, so that is $2,750. This was on Thursday of last week. On Monday of this week, which is just 3 days, we sold these for $5. So $5 times the 10 contracts is $5,000. We didn't quite double our money, but we made $5,000. Again, nice return. And it's a nice return for 3 days. Now, sometimes we do 3-day returns, sometimes 3 weeks, sometimes it takes us 2 and 3 months. And we have lost money on a couple of these, but at the time of this taping, we just did a check yesterday, and for every 13 to 14 of these options that we make money on, we lose money on 1. Not a bad rate. Not a bad rate at all. So we have one loser, one option or stock that doesn't get up to the strike price on or before the expiration date. I mean, sometimes those darn things just don't do what you want them to do. It's kind of like teenagers. They just don't perform the way they're supposed to perform. Right? Well, I've got some teenagers at home. I've got some stocks that don't perform just like teenagers don't perform. But all in all, if you get good at this strategy, you have a strategy that generates money, actual cash hitting your account, and you have a strategy, a formula, if you will, working for you that has minimized the risk. So if that's what you're looking for, is a high leveraged way, a proxy way of making money, then doing options on stock splits is a phenomenal way. Now again, in the manual and the home study courses, there's a lot more information than what I've covered here, and I hope you really get into this, and again, get to be an expert at this.
We'd like to take time out and show you actual returns. These are a few of the actual investments and their 3 to 30-day returns. Our first entry is Synopsys. They announced a 2-for-1 stock split with a pay date of November 21st. We bought 15 contracts of the December $27.50 call options. We sold them on an uptick in the stock for $7,500. Our profit was $1,125. The 2-day return is 18%. But the annualized return is 3,240%. Let's move on. On November 3rd, Sun Microsystems announced a 2-for-1 stock split. We did 2 plays on that one. We purchased the January $85 calls for $6.75 and the April $80 calls for $13.25. We then sold them on November 10th for the money that you see listed on the screen. Our profits were $2,500 on the $85 calls and $2,562.50 on the $80 calls. That is a 74% and a 39% 7-day return. We like to show the Wall Street professionals how the cab driver, Wade Cook, keeps making big-time returns and invite you to come to a live Wall Street workshop. If you are not getting these returns, call the number you see on the screen right away. We'll quickly do a few more. ValueJet also did a 2-for-1 stock split. Look at the annualized returns there. 5,040% and 5,200%. On to Automatic Data Processing, which also announced a 2-for-1 stock split. We received a 100% 3-day return and a 12,000% annualized return. Did you catch that? A 12,000% annualized return. Next, Eli Lilly. They only got us a 996% annualized return. Oh well. We have lost money on a few of these options, but the losers are few and far between. Our next play is U.S. Robotics. They announced a 2-for-1 stock split in August. The pay date was set for September 8th. The stock was all over the map, from $130 to $160 before it split. We bought the September $150 calls on August 11th for $6.875. That's 6 7/8. And we sold them 7 days later for $13.25. We also purchased the September $140 options on August 11th, and we sold them on August 17th for 75%, a 7-day profit. Do you like cash flow? Now look what we did. Our next one on U.S. robotics generated a 468% annualized return, 9% for 7 days. Oh well, they can't all be winners. But when the stock took a dip, we jumped right back in and generated more cash flow. This time 127% 8-day return, and without being too redundant, that is a 6,604% annualized return. We also bought the October $130 calls on the dip and sold them 8 days later for another 100% or 5,200% annualized return. And we do more almost every day. Well, we didn't want this to become a commercial, but we, Wade Cook's staff, believe in these formulas, and we want you to come to our live event. We just received this letter from Mr. Glenn Mueller of Illinois, and it is typical. We receive hundreds just like it. Dear Mr. Cook, I had gone to your Money Machine Real Estate Seminar about 10 to 15 years ago. I was impressed with your character and sense of honesty. This wasn't the typical hype, but instead an enthusiastic, real person. A couple of months ago, I heard you on our local Christian radio station, WYLL in Chicago, and I was interested in what you said. But more so, I believed it, because I was familiar with who you were. I purchased your introductory offer with 1 month of Win. I followed it daily. The returns seemed to be what you claimed, so I purchased your other tape set with 3 months of Win. I started trading on October 19th, 1995 with $2,900. My first trade was with your covered calls in iOmega. It took off. It went from $21 to $26 in a few days, so I let the stock back off to $23 and bought back the options I sold and waited for the stock to go to $25, then resold the options. I was called out of my stock with an overall return of 29%. I used the remaining $750 to do options. At the end of my first month of trading, I had $3,357.03 profit from my $2,900, showing 116% return. I love Win. On November 24th, 1995, I bought 15 iOmega December $40 calls for $81.25, and an hour later sold them for $187.50 for a $1,436.15 profit on a $1,297.50 investment. That's 111% return. I am extremely happy with your techniques, your teaching methods, and your Win service. I hope to learn more as I continue to follow your service. Thanks for your help. Sincerely, Glenn Mueller. 111% in 1 hour? I guess he's happy with us. We sincerely invite you to attend a live Wall Street workshop or call about the video version. The number is posted on the screen. And now, back to Wade.
The number one way I have of making money is doing options on stock splits. The number two way I have of making money is writing covered calls. And my third favorite way is doing rolling stock. Now, that's pretty much it for this tape, but I want to cover one more topic before we end this. A lot of people say, well, okay, at the time of this taping, at the time that you purchased these home study courses and all that, we were in a bull market. What about a bear market? What if things go down? Well, all right, let's deal with it. First of all, you got to understand my aversion to losing money. I hate losing money. Most everything I teach, most everything I do is so that we do not lose money. So, for example, when we talked about covered calls, when we talked about buying on dips, selling on strength, that in itself is a bear market strategy because we're buying down in this range here and then we're selling in this range up here. Now, the stocks may go down lower in a bear market, but they usually don't. I mean, they might, but they don't. Now, the next point about bear markets. There are 3 bull markets to every 1 bear market. The average bull market lasts 3 years. The average bear market lasts 9 months. Where should you be gearing your strategies? What should you be working? What should you be doing? So you play the market at hand. Now, there are bear market strategies. Buy on weakness is one. Diversify. Make sure that I don't like mutual funds because if you invest in mutual funds, most of the fund investors are all doing the same stocks. If there's a big turn, if there's a big sell-off, then there's too many people going for the exit. Everybody goes in the entrance one at a time, but remember the exit. Everybody wants to get out of those stocks at the same time. I don't like mutual funds for that one reason. Most of what I do is for bear market strategies. And again, though, there are more bull markets. So we gear most of our strategies for bull market. And you need to understand that. So, and I just don't believe that you can get rich thinking negative. You know, that's why I don't do a lot of puts, by the way, gambling that companies are going to go down. I really don't like them very much. I do a lot of calls, gambling that companies are going to go up. Now, I sell a lot of puts, which is a whole other strategy. Selling puts is probably the most phenomenal way of making money, but most of you can't do it. It takes more cash in your account and more experience. But selling puts on stocks that you don't own, on stocks that you think are going to go up, and stocks that you would like to buy anyway, is a remarkable way of making money. Well, again, there are 11 different ways that I found of making money. The 3 favorite ones that I've mentioned: options on stock splits, writing covered calls, and rolling stock. And if you'll pick one of these 3, or do a blending of these 3, diversify your account so you're doing some bottom fishing, you're doing some rolling stocks, you're getting some low, cheap price stocks, then you've got all these bear market strategies working for you in this incredible bear market that we're in the middle of right now. And if you'll apply these principles and work these formulas over and over and over again, then it'll breed success. Now, what I'd like to share with you here at the very end, though, is an invitation to you, and I'm going to put some more written material about this in your package, about our Wall Street workshop. Let me just briefly tell you what I would like to invite you to. This is probably one of the most expensive seminars you'll ever come to, but let me promise you something. You will get 10 times back from me. Every dollar that you pay me, you'll get back 10 times what you paid. I have a motto in my life, and it's extended through my company, that we never promise that which we cannot deliver, and then we always deliver more than we promise. If you come and spend 2 days with my instructors, we have a whole team called Team Wall Street. Let me tell you about what we do. We have back at the office 3 to 4 people doing research, running the computers, checking the things, doing research. Then we have a team of instructors that hit the road. Now they do 2-day events called the Wall Street Workshop. These are not just people that were fairly good at the stock market or stockbrokers. These are people that I hand-selected and then hand-trained. These are people that run my accounts. I put in $100,000 and I have them managing the money. And most of them are yielding between 20 and 30% per month. Then the question is this: would you rather do business with someone who's just a West Point graduate, or would you rather do business with a sergeant that's in the foxholes every day fighting the battles? See, everyone, I'm a foxhole sergeant. I'm in there working these deals all day long, making this kind of money, putting the things on win that we talked about, but also training these instructors. And I teach classes myself from time to time around the country, but usually I just do the ones here in the Pacific Northwest because I want to be with my family. I've retired, and I want to spend the time with my kids. But if you want to come and see me, come to the Northwest, and I do a few of these around the country, but usually I have the Team Wall Street. And why would you want me when you can have my instructors? See, these are the guys that I go to for advice. These are the ones that are looking up all the stock plays and telling me every day what they're doing, and they're making all the money. And I use these guys for advice, and so I've surrounded myself with some of the most incredible minds around. So let me tell you about the 2 days. We call it the Wall Street Workshop. It is the only hands-on, actual do-the-deals workshop ever designed. We don't call it a seminar. It's an actual workshop. I mean, don't wear your suits. Roll up your sleeves and get to work. We get to class. We have a whole couple hours on introductory material, going through vocabulary and doing all that, going through some of the very basics of setting up your accounts, what kind of stockbrokers to choose, margin accounts, and all that. But then right after that first break or the first day, we switch right into high gear. Now, off to the side of the room, we have a computer set up with a screen. And we're punching up like the Telechart 2000 using our charting services, and you can go up there during the breaks and have them run charts for you on the different companies that you're doing. Then we get our stockbrokers on the phone. Usually we pipe them right into the hotel system so they're on the phone, and we do deals in class. Now you can bring your mobile phones or go out in the hotel lobby and call your stockbroker and make the deals. See, everyone, it's what we call experiential learning. And most people have never experienced anything like this. Sequential learning, experiential learning. See, a lot of people think that they can go to a real estate seminar or something like that and learn how to overcome fear. That's not my style. My style is this. Let's do the deals, and that will overcome the fear. So if we can not only tell you what to do, but then show you how to do it, and then watch over you while you do it, then we've got the best of all worlds. I brought just a few testimonials. I want to read a couple of these. Here's a comment from David. He says, from the covered call technique Wade Cook and his staff taught today, I invested $3,937.50 and captured $750 worth of premiums in just minutes. This is a 19% return for one phone call. Try it. It works. The stock is still in my account, and so is the $750. Okay, here's another one. This is a comment by Vin T. I personally think the Wall Street Workshop is great. I learned strategies that I have never heard of. I made 2 deals in one day. I'll gain about $1,500 on an $8,000 investment. On the other deal, I'll make about $950 on a $9,000 investment. This would be even higher if I would have used my margin account. Now catch this. He's getting about a 10% return, but had he done it on margin, he'd be getting a 20% return. Here's a comment by Robert, who said, I have made a lot more than the cost of the class. 93% return in 6 days on one deal and 130% on another. All right, here's a CTL. With about $27,500 in working capital, I made about $15,000 net gain in the last 2.5 months. And by the way, that's the proof that is in the pudding. I love getting in letters from people who have been to the class, and then 3 months later, 6 months later, they tell us how much they're making. One gentleman told us that he started with $40,000, and he's made $75,000 in 3 months. Another guy started with $10,000. He's a mortgage banker, and he's made $35,000. $25,000. He has $35,000 in account, starting with $10,000. I don't know what your rate of returns are, but listen to a couple more. I bought $10,000 worth of stock and made $2,500 on the deal. I paid for the workshop with one trade. I plan to make more, much more. All right. Here's a person said, after attending the Wall Street workshop in March, I opened an account with Charles Schwab with $3,600. After doing rolling stocks and a covered call, I have nearly doubled my cash value to $7,165. If I had not procrastinated and actually done more of the things that were taught me, I could have significantly raised the cash value of my accounts. I mean, I got more pages, and I got pages and pages of testimonials and the money that people are making. Now, what we're talking about is results. I'm a results-oriented person. You come to class, we do the deals in class. Here's my promise. Every class we try to find, sometimes 8 or 9, but we try to find at least 3 deals that are going to give you an annualized return of over 300%. If you were to do these deals, I mean, it's going to more than pay for. I don't know how much money you have to start with, whether you have $2,000 or $5 or $10 or $15,000 to get started, or even $100,000. How would you like to learn how to take $100,000 and have it generate for you $250,000 a year? Now, that's what I have, that's what I do, and what I teach, what I show, what my instructors show is how to make that kind of money. Now, right now, we also have some specials because we realize that you're going to have to travel to come to the Wall Street workshop. So when you call the 800 number, and call the number on the screen, it's 1-800-872-7411. Ask for the extension number listed there. And when you call this number, you're going to see that we're going to, you're going to go through a couple of things. One is ask about date availability. Now, these classes are sold out all the time. If you want to get signed up, you need to sign up right away. When we're in Washington, D.C. or Orlando or Texas doing a class, when they sell out, we can't put any more people in the room. They're sold out. So if you want to get signed up for a class, you need to do so right away. I'm also going to throw in a $500 travel credit. Whether you actually spend that much money or not, I'm going to knock $500 off. And at the time of this taping, and I hope it's still available when you watch this, we have a $500 tuition credit scholarship fund that I set up to help you pay for the tuition. I want you to come to this. And right now we're also including an entity structuring workshop for $995. It's a one-day event at the end. So there's 2 days of the Wall Street workshop and then a $995 one-day entity structuring workshop, and we're including that for free. So again, you need to call the 800 number. When you call the 800 number, just ask about the availability, the scheduling, and the time, and what it's going to take for you to get into the class. I promise you one thing. I promised this before, I'll do it again. You're going to make a lot more money than the money you paid me. And as a matter of fact, this is the first time that anybody has ever created a course that will cost you about $100,000 to stay home. So if you sit there right now, watch this, and don't call, and don't come home, it's going to cost you at least $100,000 depending on the money you have to get started with. So if you want to learn how to generate this kind of cash, and we do have a guarantee, by the way, and the guarantee is simple. We will give you 3, possibly 5 ways of making at least a 300% annualized return at the class or within 30 days of the class, and if we don't, you get your money back. So the burden is not on you, the burden is on me and my staff to produce, to give you 3 to 5 ways of making at least a 300% annualized return. And think about that. I mean, you have absolutely nothing to lose. And that's what I wanted to have. I wanted to have a course that will cost you more to stay home than to attend, and also one that you would think that it's just crazy for you not to come. And I'll agree, it's crazy for you not to come. And I look around. I want to say that our class is the best. But when I look around, there's nobody in second place. There's nobody teaching what we teach at the Wall Street workshop. Now, as part of Cook University, and we have that available too, you need to call right now and tie into our hands-on, live, action-oriented workshops and get yourself up to making this kind of money in class where we can help you make it, again, by telling you how to do it, showing you how to do it, and then watching over you while you do it. Again, this is Wade Cook. I hope to see you at one of our live Wall Street workshops.
Keep looking. Keep looking.